So hello students. Today we will be looking at first of all evaluation of bonds, and if you recall, we had done this during the last class, but I will revise that today, and thereafter we will go on to do understand how we can value companies. So basically, today's class is about valuing, first of all, an individual debt instrument like a bond, and the other is a company. The basic principle behind them are the same. Both the bond and the company have a distinct set of cash flows. And these cash flows are in the future. If we can correctly predict these cash flows, in the case of a company, it helps us to discount them and arrive at a present value. And there are, of course, other factors like the terminal value of the company, which we will discuss when we get to that part. But first of all, I'd like to just continue with what we were discussing last time with regard to bonds. So I'll just share my screen. Okay. Just a moment. Okay, so here we have our valuation of bonds. This, if you recall, this is something that we had done during the last week. So I'll try to revise this first of all, because I understand that there were problems with understanding some of the concepts here. And then we'll move on to the valuation of companies. So let's go to the first part here. Let me just put this in presentation mode. Here we are. So first of all, just understand, bonds are long-term debt instruments. They are sources of capital for companies and instruments of investments. So essentially, anybody investing in a bond, he's aware of its face value, or as we say, the par value of the bond. This is the price at which the issuer basically issues the bond. And anybody buying the bond buys it at that price. Then there is the market price of the bond. As the bond gets traded in the market, the price of the bond tends to change. It goes up and down. And the market price of the bond, or even the face value of the bond, will always equal to the present value of its expected future cash flows. And what are these future cash flows? These are the interest payments and the payment of the actual bond amount back to the investor. Now, why does this fluctuate? After all, it's a debt instrument. Why does this fluctuate? So basically, what happens is that there can be a situation where other bonds come into the market which are priced differently. And in that case, depending on whether that bond is considered to be more valuable or less valuable than this bond, the price of this bond tends to go up or go down. So that's the first thing to remember. And depending on whether it goes up or go down, the price in the market will be either above the face value, in which we say it is above par, or it may be below the face value, in which case we say that it is below par. So that's the first thing to remember here. Then we just remember some of the basic terminology which is there for a bond. So the first thing is that the rate of interest at which the bond is issued and which is payable by the issuer is known as the coupon. So essentially that coupon may be 5%, 5.5%, 6%, etc. Normally this is paid half yearly basis. Here in the examples that we are taking, for the sake of simplicity, we are taking it on an annual basis. Now, the practice is to pay the interest at 6-month intervals. So the amount of interest paid on a rupees 1,000 bond with a coupon of 5% would be rupees 25. Now, if I were to look at this on an annual basis, I would basically be paying rupees 50. Now, the yield is the effective rate of return the holder of the bond will get, considering the coupon of the bond and the price at which the bond was purchased. So basically, depending on the price which the bondholder paid for the bond, what will be the actual return that he gets? That is the yield. So if he had bought the bond below par, effectively he'll get a higher yield. If he had bought it above par, effectively he'll get a lower yield. Because remember, in the bond, the amount of payment at maturity is fixed, and the amounts of interest payments prior to maturity at those half-yearly intervals or yearly intervals, that's also fixed. So if you buy it at 100 and it has a coupon of 5.5%, face value is also 100, then in that case, you hold on to the bond, your yield is going to be 5.5% for the entire period. But if you buy it less than 100, then in that case, your yield will be higher than 5.5. If you buy it at more than 100, then in that case, your yield is going to be less than 5.5, which is the coupon of the bond. Now, that's one part. The second thing is, this yield that we speak about, this is also known as the YTM, or the yield to maturity. So you can think of this as the IRR of the bond. Remember, we said that if you take any bond and if you discount all the payments which come, the rate at which they are discounted, so that the total of the discounted present values is exactly equal to the face value, that rate is known as the IRR. And if you recall, we had done this exercise in Excel, where I had shown you that simple Excel formula equal to IRR, and you just select the particular the range in Excel where the values are given, the values of the present of the cash inflows, and you get your exact present value, which in the case of a bond which is bought at par will be exactly the same as the coupon. So the calculation of the yield considers the future interest payments expected and the return of the bond amount on maturity. Now, what is the yield for the original purchaser of the bond? Same as the coupon. Now, let's think about it like this. Suppose the company itself issues the bond not at its face value, but at, let's say, a little above face value, above par, or a little below face value, that is below par. Then what happens? So when a bond is issued to investors below its face value, it is said to be at a discount. So a company can issue a 15% 7-year bond below its face value. So let's say the face value is 100 and the bond is issued to investors at rupees 94. So this does not change the coupon rate of the bond. The investor will still basically be getting rupees 15 per annum, because that is the coupon. Now, in this particular case, what is the yield on the bond? Since it is paid at, since the price of the bond is 94, that is the price at which the investor bought it. So the yield would have gone up because he's paid less, but he's getting 15 rupees per 100. Right now, he's getting 15 rupees for the 94 rupees which he has paid. So, based on what we have learned so far, the cash outflows for the company will be rupees 15 per annum for 7 years, and it will redeem the bond by paying rupees 100 back in the 7th year. Now, the investor has paid less than the face value, but is still getting rupees 15 per year, or 15% on a face value of rupees 100. Since he has bought a rupees 100 bond for rupees 94, that is less than the face value, for the investor, the effective rate of interest is higher than 15%. So you might recall this little chart, this little table which I'm giving it to you as basically as an extract from an Excel sheet, which is the manual way of calculating the IRR. And what are we doing here? We are basically getting the present values of each of the cash flows. So when we say that the company is going to be paying rupees 15 for 7 years, what we are doing out here is that we are discounting each of the cash flows by the discount rate, or that is the coupon. So in the first case, I do it by 15%. In the second, by 15% squared, 1 plus 15% squared, then 1 plus 15 to the power 3, and so on till we get to the 7th year, where I say 1 plus 15% to the power 7. And similarly, this will be the denominator for discounting the repayment of the principal, which is rupees 100. And when I do all this, I get the present value of the bond. Now, in this particular case, since I paid less, if I cannot do this manually, because manually it's a very, very long process. Getting the IRR manually, as we discussed when we were discussing IRR, that it's going to be a very long process, but you can do it in maybe 30 seconds using an Excel sheet. So you take an Excel sheet, you plot the values. So you paid 94. So since that's an outflow for you, you show that with a minus sign. And over the next 7 years, you show the amounts you will receive. So it's 15 rupees for each year. And then in the last year, I've added the amount of principal, which is rupees 100. So that's 115. And if we discount each of these in this way, in the way we've discounted it here, you will find that the IRR comes to 16.51% because you began with 94 rupees. Now, what you notice here is that the IRR has gone up from 15% to 16.51%. Just keep a track of this. And also remember that this IRR that we are talking about is basically the yield or the yield to maturity. So for you, the effective rate of return on this bond is 16.51%, not 15%, because you did not pay 100 rupees for the bond, you paid 94 rupees for the bond. Now let's take another case where the bond is sold at a premium. Now in this particular case, let's for this example, that the company issues it at rupees 105. Everything else remains the same. It's a 7-year bond. It's going to pay you rupees 15 per annum. Now, if you do the same Excel calculation, you'll find that you have an IRR of 13.84%. Why is this the case? Because I've paid more. 15% was being paid on rupees 100. Now I'm basically getting that 15% after buying that 100 rupee bond for rupees 105 only. So because of that, my yield actually goes down. So what do I see here? That the bond yield and the price are inversely related. At rupees 100, the yield is 15%. At rupees 94, the yield is 16.51%. So when the price goes down, the yield goes up. And at 105, the yield is 13.84%. So when the price goes up, the yield goes down. So what is the principle that we get from this? Bond yield and price are inversely related. So this is one basic principle which you should remember always. This is one point. Now, let's just look at the impact of inflation on a bond. So let's say the principle that is derived from this is that we've already said this, that price and yield move in opposite directions. Now, what happens if there is inflation? Now, as we know, if prices increase, that means the purchasing power of money goes down. So effectively, you can buy less with the same amount of money once there is inflation. So now what will happen? One of the basic, the theories of inflation, basically, this is the monetary theory, which says that inflation is because of changes in money supply. So basically, if I have a situation where the quantity of money that I have in the economy is relatively speaking higher than the amount of goods that are there. So what I then have is more money chasing less goods. If this happens, basically those goods gain in value, their price goes up because there is more of money chasing it. So what the RBI will do, as part of its monetary policy is to reduce the inflation by increasing the interest rates. How does that work? So if the interest rates work, there is an incentive for members of the public to basically take their money and deposit it in banks. Similarly, banks can take their extra cash and deposit it with RBI because everybody is now getting a higher rate of interest. What does RBI basically hope for here? RBI is hoping that as money supply in the economy comes down, what will happen is that inflation will also come down. This is the basic theory. And because of this, what happens is that if the government has to issue a bond, the bond also has to have a higher coupon. Because of the inflation, the lower coupon now will not attract people. They will say that if you give me a very low coupon, it's going to be eaten away by the inflation. So my real rate of return is actually much less. So what should you do? You should give us a higher rate. So when the government, and remember the government and the RBI, they're interested in attracting money. So if they want to get money from the public, what is the incentive they give them? A higher rate. So just as the central bank raises interest rates, the immediate impact of that is that bonds issued during this period will also have higher coupons. So that's the first thing here. Now, if the rate is higher, the existing bonds will lose value as their future payments will have to be discounted with this rate, which is higher than the coupon of the bond. This will reduce their value as we have seen in the slides preceding. So one of the principles we saw in the earlier slide was that if the rate goes up, the price goes down. So basically what happens is, let's say the existing bonds are there. Now these existing bonds, let's say they had a rate of 5.5%. And the new bond which comes in the market, which is available for the same price, has a return of 6%. Then it stands to reason that the new bond is going to be more attractive for members of the public. Nobody is going to buy the old bond because it is giving a lower coupon. So effectively what will happen is, what does the market do? It sort of takes the price of the lower yield bond and it reduces it so that the yield of the two both now becomes 6%. That's the basic thing. If then these two bonds are equal, so you can either buy a 100 rupee bond and with a coupon of 6, or maybe a 94 rupees bond also with a coupon of 6. So basically what is happening is that as the bond basically goes up, the yield tends to, as the yield goes up, the prices go down. That's the basic idea here. Now, how do I calculate the value of the bond? So determine the amount of each coupon payment and the number of remaining payments. payments. So if the coupon rate on a 5-year rupees 1,000 bond or treasury bill issued in November 20 is 5%, it would pay rupees 50 annually until it matures based on a single annual payment. If you're pricing this in September 22, 2 years later, this bond in the market, what would its price be in the market? So there would be 4 payments remaining because the bond matures in November 25. So the bond is maturing November 25. I want to buy the bond in September 22. How many payments are remaining? The payments for November 22, November 23, November 24, and November 25, when I will not only get my interest payment, but I will also get back the principal. So as you can see here, this is the stream of payments which are receivable in the future. Now, if I can discount these by the present value, then in that case, I'll be able to get the appropriate, at the appropriate discount rate, I'll get the actual market price of this bond. Now, if there had been no change in the rate of interest, let's say there had been no change at all in the rate of interest, the RBI also was maintaining this 5% interest rate, then of course, this bond would not have changed in price. It would be the same. But if the, let's say the bond or the treasury bill issued by the government in recent times is 5.5%, then it means that all these cash flows which are receivable in the future will now have to be discounted at 5.5%. So if an investor had purchased a T-bill today, he would have got 5.5%. So we will discount the bond's future income streams by 5.5% and arrive at the value of the bond. So what is the appropriate rate here? The appropriate rate is the 5.5% rate because this is basically the opportunity cost for the investor. Remember, the opportunity cost is the next best option that you have. So right now, the next best option that you have is to buy the 5.5% bond. Here, you're only getting 5%. So what you'll do is you'll take all the future cash flows of this bond, discounted by the new discount rate of 5.5%, and then find out what the price of this bond is. So we do it here manually on this Excel sheet here. So these are the future cash flows which are due. So I have November 22, I'll get 50 rupees. I discounted by 1.055, that's 1 plus 5.5. I get a present value of 47.39. So the first year's payment of rupees 50, I'm getting, I bought it in September 22. In November 22, I'll get 50 rupees. Its present value is 47.39. Now, November 23, I'll again get 50, but this time I'll be discounting by 1.055 to the power 2. So the figure is bigger, 1.113. And what will I get? I'll get 44 rupees 92. So it's less than 47. Third year, this 50, now discounted by 1.055 to the power 3, gives you 42.58. It's still lower. And so on. You get the, if you add up all these, you get 982.49. So the present value of the future cash flows of this particular bond works out to 982.49, but it has a face value of 1,000. What that means basically is that the market price of this bond is going to be only 982.49. So what has happened? Since I'm discounting the cash flows with a higher discount rate of 5.5%, therefore, the present values have gone down to by roughly 1750. That is the point to remember. Every time a new bond comes in the market with a higher coupon, it is going to affect the value of the bonds which are already being traded in the market. So during inflation, if the RBI issues a higher priced bond, it is going to reduce the market value of all the other bonds which are there, which were issued in previous times in the market, which had uh, higher coupon rates, lower coupon rates. So now, with that in mind, let's look at this: bonds, interest rates, and inflation. So we know that bonds are debt instruments issued by the government or companies with a good credit rating, and they do not carry a credit risk. That means there is no risk of default, or at least it's very minimal. Because remember, in the case of a bond, it's backed up by the assets of the company. In the case, when a bond is issued by the government, it's a sovereign debt. So there is no risk at all. So in that case, what is the risk that the investor faces? The risk you have is inflation, in which case, what we just saw, the cash flows that you get, they have less purchasing power, so you're losing there. The other rate you have is interest rate risk. That is, if a bond with a higher coupon comes in the market, then your bond, which has a lower coupon, is going to lose value. This is basically interest rate risk. Now, like we said, the Reserve Bank increases rates of interest on bonds and also the repo rate. That's the rate at which it lends to banks whenever there is inflation. Why? Because, like I told you, this is basically because they want to reduce the money supply. Because the theory is that if there is inflation, it indicates that the amount of money circulating in the market is pretty high. So if I can reduce that, I will bring inflation under control. So when the RBI raises interest rates, it is making investment in debt instruments more attractive for investors, both institutional and individual. First point. Investors will have an incentive to deposit their money in banks. Banks, in turn, can deposit their extra funds with RBI. Both will benefit by getting higher rates of interest. Now, RBI may also issue bonds with a higher rate of interest. These are bought by banks and are traded on the money market. So what is the money market? Basically, the money market is a market in which institutions participate, and it deals in wholesale amounts of money. So who will be the basic players in the money market? It will be banks. All the banks are going to be there. RBI will be a player. Some of the public sector undertakings may be there. So there won't be any individuals. And everybody who is there is looking to buy or sell big amounts of bonds. So if somebody wants money, he'll be selling bonds to get money. If somebody basically wants to invest, the person is basically buying bonds and buying it and basically releasing its own liquidity. So bonds are traded in the money market. If the coupon of a new issue of bond is higher, it affects the market price of all bonds that are traded in the market. Those with a lower coupon will lose value, as investors will prefer to buy bonds with a higher coupon. Now, let's have a look at the impact that this is going to have on the interest, how the prices of different bonds are going to be changed because of this. So the expected future cash flows of each bond, that is the interest payments and final redemption amount, are all discounted by the new rate to get their present value, what we just discussed in the last slide. The impact of this is that those bonds that have a coupon that is lower than the new interest rate offered on bonds will have a lower present value. So we'll see this in an Excel sheet also. So by the same logic, those bonds that have a coupon that is higher than the new interest rate will gain in value as more investors will want to buy it. Now, suppose these are the RBI issues a new bond with a coupon of 6%. So what are the existing bonds? Bonds that had been issued by RBI in the years gone by. They had different rates of interest. So let's say there's one bond which had a rate of 5.5%. It was issued about 7 years ago, and today it has 2 years left to maturity. So anybody buying this bond or anybody having this bond is basically going to get 2 coupon payments And apart from that, he'll get the principal back. Now there's another bond. This has a coupon of 5.7%. It is 1 year to maturity. After 1 year, the whoever buys this bond or whoever is the holder of the bond is going to get back the principal along with the interest. Another bond has exactly the same rate of interest or the same coupon as the new coupon, which has the new bond which has been issued, which is 6%. This one has 3 years to maturity. And then we have bonds with a coupon of 6.3% with 1 year to maturity. So among all these 4 bonds which are there in the market, basically there is only this 6.3% bond which basically has a higher coupon than the one issued by RBI. So in the first bond, what is left, what exactly will be paid? There are 2 more interest payments left of rupees 55 each, apart from the 1,000 rupees, which is the face value of the bond. In the case of this bond, let's call this bond, this one, let's call it bond A, let's call this bond B. So then there's 1 more interest payment of 57 apart from the face value of the bond, which will be redeemed. That's 1,000. In this case, there are 3 more interest payments of rupees 60 because the coupon is 6%. And after which the rupees 1,000 will be repaid also. And in the last case, let's call this bond D, there are 2 payments of rupees 63 each apart from the redemption of the bond itself at rupees 1,000. What is going to happen is, if you simply apply that principle, if the coupon goes up, the price goes down. So basically, in relation to this bond here, this 5.5% bond here, the coupon has gone up to 6%. So the price should go down. Similarly, for this bond at 5.7%, if you compare with the new coupon, what has happened is that the coupon is higher. So the value of this bond also should go down. In the case of this, there is no change. This bond had a coupon of 6% and the new coupon is also 6%. So there's no change in its price. In the last case, basically what happened here was that the coupon was higher than the coupon at which the new bond is issued. So if the yield goes down, which is the case for this bond, the price goes up. So here, this one is actually going to show an increase in price. Now, if I go to an Excel sheet and look at the calculations here, you'll get a fairly good idea of how this actually works. So let me just take you to an Excel sheet. Sorry, wrong Excel sheet. Just let me get the right one. Okay. So here, let's just look at, see, what I've done is, I've basically manually calculated the amount, the present value of the future cash flows of each of the bonds. So we said that bond A, this had been issued with a coupon of 5.5%, and it has a maturity, a 2-year maturity. So 1,000 rupee bond issued at 5.5%, it has a 2-year maturity. So if I plot it like this, in year 1, I'll get 55. Remember 2 years. Year 2, I'll get 55, but I'll also get the 1,000 rupees, the face value of the bond back. So these are the two things which I can expect. Anybody buying this bond is going to get this amount, 55 and 1055. Now, what is my discount rate? My discount rate is going to be 6% because that new bond that has been issued by RBI, that has a discount rate of 6%. The coupon is 6%. So the first cash flow of 55, I can basically take this and divide it by the new discount rate, 1.06, 1 plus 6%. And I find that the present value of this 55 is 51.89. So this 55, which I'm going to receive 1 year from today, in today's money terms, value terms, it comes to 51.89. 2 years hence, I'll be receiving 55 and 1,000. So I've added them together, 1055, and I discounted by 1.06 squared, which comes to 1.1236. Now, if you divide this by this, you're going to get 938.95. I add these two up. What I get is the market value of the bond today, which is also the sum of the present value of the future cash flows. So instead of 1,000, the value has come down to 990. Why has this happened? Because I discounted the cash flows by a discount rate that was higher than the coupon at which the bond was issued. So the bond was issued at 5.5%, but I discounted it with a rate of 6%. So if I divide this by a bigger figure, obviously this is going to go down. So it was 55, it came down to 51.89. This was 1055. 2 years hence, it came down to 938. Market value of the bond comes down to 990. So this went up, yield went up, the market value or the price of the bond came down. Now let's take the second bond. We said that in this case, the existing bond had a coupon of 5.7% and it had a 1 year maturity. So in this particular case, it's very simple. 1 year hence, I'll be receiving 57 rupees, the amount of interest, and I'll be receiving the 1,000 rupees, which is the face value of the bond that is being redeemed. I'll get that back. So this 1,057, if I now discount this by 1.06, what will I get? I'll get 997.16981. You can shorten that to 997.17. So once again, what are we seeing? We're seeing that as the discount rate has gone up, the price of the bond has come down. Now, in this case, it was 990. Here it is 997. Why is this higher than this? Because here this bond already had a coupon of 5.7. New rate is 6. So the basic difference in the discounting is that 0.30%. Here it was 5.5%. The new rate is 6%. So the difference is basically 0.50. So because of that, this has a lower value, this has a higher value. Now the third one, take the third bond, which already had a coupon of 6%. And it had a 3-year maturity. So what will I get here? First year, I'll get 60. Second year, 60. Third year, I'll get 60 plus 1,000, 1,060. Now, if I discount these by the present, the coupon of the bond which RBI has just issued, that's 6%. What will I get? I will basically be discounting by 1.06 here, 1.06 to the power 2 here, 1.06 to the power 3 here. If you add these up, so you get 1,000. Why is this exactly 1,000, the same as the face value? Because the future cash flows have basically been discounted by a rate which is the same as the coupon of the bond. So that's the basic thing which to remember here. Everything depends on the discount rate. Is it different from the coupon or is it the same? If it's the same, there's no change in the value, it remains the same. But if it is higher, if the new coupon is higher, then the prices of these bonds are going to go down. And the larger the difference between the coupon of the bond you're valuing and the new bond, the new coupon that has come, the larger will be the drop in price, as we saw here. Now, in the third bond, here, see, the case is different. Here, what has happened is that this bond had a higher coupon. So since it had a higher coupon and the new coupon is less, so this bond is still very attractive. Therefore, its value goes up. How do we get that? It had a 1-year maturity, one payment is left. So 63 rupees, the interest part, and 1,000 rupees, which is the redemption of the face value, discounted by the coupon of the new bond, 1.06, and I get 1,002.83. So as the coupon went down, the rate went up. This is the basic thing which you need to do some of these exercises yourself. I would strongly suggest you take an Excel sheet and try to take hypothetical cases. Just take a bond, look at what the simple interest will be from year to year, and then discount it at different rates. You will find that in each case, the sum of the present value of the future payments will keep going up and down depending on whether you have increased the discount rate or whether you have decreased the discount rate. And then the logic of this will be absolutely clear. And then you'll also see the relationship between inflation, the rise in interest rates, and the change in the prices of bonds. So we'll now continue with that discussion here. So now let's look at this again. This is actually what I'm doing is I'm reading out an extract from a financial newspaper called Mint. This appeared in April this year, 2022. It's a little report on what has been happening in the United States. So the Federal Reserve Bank in the US, that's the counterpart of our RBI. So over the last 2 years, what has the Federal Reserve Bank done? Its balance sheet has grown from approximately $4 trillion to $9 trillion. This increase is, why has this happened? It's pumped money into the market. Basically, this is the support it has offered to banks and the economy in response to the COVID-19 pandemic. Now, how did they offer this support? It told the banks that you have bonds with you, sell them to me, and I'll give you money. So in that way, basically what happened was it pumped money it pumped roughly $5 trillion into the economy. The idea was that the banks would take this, give low interest loans to entrepreneurs, to industrialists, to existing industries. And as these people invested that money in the economy, there would be economic growth, there would be employment, and this recession would be a thing of the past. This is the logic. Now, these supportive measures, low interest rates and bond purchasing, aren't intended to run forever. You can't keep doing this. So the Fed intends to normalize its policies and reduce the inflation we are seeing. So as the money supply, this money which it pumped into the economy, as it increased, basically what happened was that it at some point of time became inflationary, because the production of goods didn't keep pace with the money supply. So the idea was that as I increase, I use this to kickstart economic growth, production increases, so the quantity of goods in the economy also increases, and then inflation goes away. Now, in order to unwind the balance sheet, the bank will need to sell these bonds, which will increase the supply of bonds in the market. So basically what will happen is, if the Fed wants to reduce the money supply, what is it now going to do? It's basically going to ask, it's basically going to buy these bonds back. You know, so the bank will need to sell these bonds, which will increase the supply of bonds in the market. So the Fed's intention is to sell about 95 billion worth of bonds each month. So it had the bonds from the banks. It sells these bonds back to the bank. And when it does this, basically it takes the money out of the economy because the banks basically paid for the bonds. Now, all else being equal, increased supply of bonds leads to lower bond prices and higher yields. So now it's a simple supply demand thing. As I increase the number of bonds in the market, basically what will happen is the prices will come down, demand supply, and the yields will go up. So I've tried to show this again out here. So COVID pandemic in the US leads to a contraction of the economy. Basically, what is happening is businesses are shutting down, people are losing jobs, production is coming down. So the amount of goods in circulation in the market is coming down. So since 2020, Federal Reserve Bank purchases bonds held by banks and pumps money into the market to give more funds to banks so they can give loans and restart growth. Now, by April 22, the economy revives a little, but there is inflation. So the Fed begins to sell bonds so that they can restrict money supply. So when it sells bonds, obviously what will happen is that the banks that cycle will return. It will be a reverse. The money will come back to the Fed. Bonds will go to the banks. And in the process, increased supply of bonds leads to lower bond prices. More supply, less demand principle. Low prices means high yields, like in the case of bonds sold at a discount. So remember when we said that the price goes down, as in the case of a bond selling at discount, basically the yield goes up. Now, I've tried to show this here again. So banks have to maintain a stock of bonds issued by the Fed in the US. This happens in every country. So every country, the regulator will say that banks should keep a certain amount of their deposits in the form of bonds, so that if they run into trouble tomorrow, at least this buffer is there. Next, if there is a recession, the Fed will buy the bonds from the bank and pump money into the economy. What will happen? Banks will sell bonds to the Fed. So here it's going to the Fed. Feds give dollars of 9 trillion to banks, like this. Now, the moment you want to reverse this, what will happen is that if you want to reverse this, it will be the bonds going back from the Feds to the banks and the dollars flowing back from the banks to the Fed. So I can make one more, reverse this box and show you these arrows going now in different directions. So basically, this is what had happened. And this process is known as quantitative easing, where you basically you give, money at very low rates of interest to the banks. And in the process, you hope that the banks will use this to revive the economy. That's the whole process. And that is how the yields of the prices of bonds get impacted. That's the basic point I've been making here. So I just hope that between the lectures we had last week and this week, what we just had, you are now clear about the relationship between bonds, prices and yields on the one hand, and then inflation, interest rate, and then its impact on the prices and yields of bonds on the other hand. If that is clear to you, then I think the purpose of these two lectures are served. So what we'll do now is we'll take a 5-minute break and come back. Now what we're going to discuss is the valuation of companies. And that is the second part. What we just finished with was the valuation of bonds. And now we'll go back to the valuation of companies, like I told you in the beginning. So before we do that, we'll just take a short break, after which we'll start with the valuation of companies. So I'm back with the second part of today's class. So we'll now be doing the valuation of companies. So let me just share my screen with you. So basically, when we say value of a company, it can be a number of things. If you just think about it, one way of looking at value is if I just take a company, sell all its assets, what will I get? So that's one way of thinking. Like, for example, if we want to know the value of our house, what would we do? We want to basically go and find out what the market price of my house is. So if I sell the house, what will I get? So you can look at the company's value in basically two ways. I can look at it in terms of its assets, same concept. So I could think in terms of the book value of the assets. I could think in terms of the liquidation value, the replacement value, the reproduction value, market value, fair market value. There can be many, many different ways of valuing the assets. That's one way. Now, what could be the other way of looking at it? If assets, see, this is the normal approach. Any of us, when we think in terms of our own personal assets, we generally think in terms of the market price of these assets. So that's quite normal. The other way, the way to do it in finance is to look at the revenues. The same concept. What is the amount of revenue this company will earn in the future? Just like when we looked at the bond, how did we value the bond? We valued it by looking at the future cash inflows expected from that bond. So similarly, in the case of a company, I'll try to forecast the amount of revenues it is likely to have in the years ahead, and then try to see what the revenues are. So here, one of the approaches which are very common is the discounted cash flow approach. Sounds, it's basically, when I say discounted cash flow, I've already been doing this when I did use when I got the present values of the future cash inflows of my bonds. So I can get the cash inflows of the company and apply the same method with an appropriate discount rate to find out what the present values of these future revenues are going to be. So that could be one way. The other is what is known as a relative valuation. This sounds a little complex. It is very simple, as you'll see when we get to it, where we use different multiples, like the price earning multiple or the EBITDA multiple, and we try to find out what the value of the company is based on this. So we'll get to that. Now, let's take the first one, book value. So basically, what do we have here? The cost of assets minus the accumulated depreciation. That can be one way of looking at it. So book value is total assets minus intangible assets minus the outside liabilities. Whatever is left, that is basically what the value of the assets are. And which value are we talking about? The value on the books of the company. So we're not looking at what the market values it at today. We're looking at, in terms of the accounting books of the company, what is the value of each of its assets. And we say that this is our book value. So what is the purpose of this method? Obviously, this method will have, it takes into account things like depreciation. It will not take into account appreciation in land values, in the values of other assets. So basically, this is going to be a fairly low price. So it's like it provides a floor price for the company. So basically, you have a basic, it's like a reserve price. This is the price. What we're really looking for is something much higher than this. Now, Disadvantages only reflects the values at which the assets are held on the books, which is the purchase cost less depreciation. This may be very different from the actual market values, what I've been saying. Now, think of liquidation value. So suppose a situation comes where I want to actually sell this company. In that particular case, what will happen is that I will, basically take the company, put it out there on the market, and in the process, I will find out what somebody is willing to pay for my company. But the very fact that I am selling it and I need the money in a hurry means that this is going to be seen by the market as a distress sale, which basically means that it won't offer too much. So in that particular case, the value that I'm likely to get is going to be low. That you just keep that point in mind. So in terms of definition, what do I say? The net amount that can be realized if a business is terminated and the assets are sold piecemeal. That is one at a time. If I were to do this, what would I get? But like I said, the market is going to see this as a distress sale, as someone who needs the money and he wants to quit. In which case, market will drive a hard bargain and won't give you the actual value. It will give you something much less. So orderly liquidation is a little better. You do it over a period of time. But if it's a forced liquidation where it has to be sold as quickly as possible, let's say the banks have got into the picture, your creditors are there in the picture, your company isn't doing well, and they say that, look, we are going to enforce our rights on the assets of the company. You haven't been able to pay us back. Therefore, we will sell all the assets of the company. So it's a forced liquidation. It's going to be done in a hurry, and the bank is not interested in getting the full amount of worth from the assets that it has. All it's interested in is it needs to get enough to adjust the loan that outstands on its books. So in this particular case, the amount of money that you'll get will be low. Then this can be another benchmark of floor price. If this were to be done and you get a value, you'll know that, okay, this is the lower rate at which I can actually sell my company. So what are the disadvantages? It's often at distressed sale prices. Sometimes liquidation takes places in a weak economic environment. So the value is reduced as there are few buyers who are willing to pay. Just imagine if a company was liquidated during the COVID pandemic. What will happen? Nobody has money. Somebody who does have money is going to drive a very hard bargain. He'll say, okay, you need money. I'm willing to pay you for it, but I'm going to pay you only as much as is necessary. Because you're in trouble, you need the money. I certainly am not going to give you a very good deal here. So in that particular case, it's going to be a buyer's market. You as the seller will lose. Third, key personnel may leave a distressed company once the sale process starts. This can further depress the price. Remember, people who are working in the company, they basically need to get out while the going is good. So if they find out that this company is going to be sold, and if the company is sold, they lose their jobs, then in that particular case, and see, it's not just being sold, it's being liquidated. So the company won't exist anymore. If the company doesn't exist anymore, their jobs won't exist anymore. So in that particular case, these people are going to leave. And if they leave, there is any hope of reviving that company is over. So if the person who was, let's say, liquidating it, just thought in terms of reviving it, let's not liquidate, let's try to run this thing again, even that opportunity is gone because the key personnel are going to leave. So basically what this happens is that the price gets depressed even more. Now, let's look at replacement value. So suppose I want to replace, create a company exactly similar to the one that I have. What will be the replacement cost? The current cost of acquiring a similar property which is likely to produce the nearest equivalent utility. So basically, an estimate of replacement value takes into account how an asset would be replaced with newer materials and current technology. So there are machines, there are tools, there are various other small assets which are there. I want to replace all these. So if I were to buy these today, each of those machines, there would be a small upgradation in technology involved. In some cases, the sort of materials that I'll use will change. But then ultimately, what will be the price of this? And I can say that this is the replacement value of this company. If I were to basically set up this company on my own, let's say I have two choices. I can either buy an existing company or I can set up an exact duplicate of this company by buying all the assets in the market, getting the human resources, and making myself have the capacity to produce whatever this company was producing. If I do that, what will be the cost? And this can become the basis of the valuation of the company. So the cost of replacement is, let's say, $1 million. So I'll say, fine, I'll offer you $1 million. One way of looking at it. Another is the reproduction value. The cost of a duplicate asset based on current prices, the latest technology and materials would not be considered here. Relevant for assets that do not produce income directly, like furniture, office, equipment, etc. So let's say the type of assets I'm using here, there is no technological upgradation involved. So I will basically reproduce exactly what is there. If I do that, what is the total cost that I will incur? And if that cost is, let's say, 500 million, I will say, fine, the value of this company is 500 million. It's simply different ways of trying to put a figure on the value of the company. Okay. So now let's look at another, aspect. So a company which functions over a period of time, it picks up a certain brand value. If I were to ask you what toothpaste do you use, you say Colgate. That means Colgate has earned your goodwill. So similarly, there are different, let's say, pharmaceutical shops, medicine shops. You go there. We tend to be a little, choosy about the medicine shops we go to, because we want to buy medicine which is, let's say, not spurious in nature, which is authentic. It's not as if, I'll buy it anywhere where there is a risk of getting something which has already expired, some sort of fraud is going on. So I go to places whom I trust. Now, the trust is an intangible thing. But I know from experience that this particular brand, let's say I'm talking about Wellness Forever. So Wellness Forever has a whole chain of medicine shops. Or if you're not familiar with Wellness Forever, think of Apollo. Apollo has a chain of medicine shops. I can go to Apollo because I know that, yes, Apollo is a trusted brand. Any medicine that they sell, this medicine is going to be genuine. So I'm trusting Apollo. This trust is the goodwill that Apollo has. And because of that goodwill, there is a certain market which is, it's loyal to Apollo. So the goodwill is defined as a type of intangible asset. So this particular belief that customers have, that arises when a business as a whole has a value greater than the value of its identified tangibles. So that Apollo is not just, the value of the medicine. Suppose I were to buy Apollo along with the brand Apollo. I'm not just buying the stock of medicine that is there. I'm also buying the goodwill that Apollo has. That means when I actually take over that shop and I sit there and I begin selling medicine, people are going to come because they believe in Apollo. So the value that Apollo has actually is more than the actual cost of medicine that it has. That's the point in goodwill. A fair market value, the highest price at which a property would change hands between a willing buyer and a willing seller with full reasonable knowledge of facts under no compulsion. So basically these two people, the buyer and the seller, they know all about the company. There's nothing hidden. from the buyer. The seller obviously knows what his company is like. So both parties have all the information there is. Both of them, this guy is not making a distress sale. The seller is willing to run the company. The other person is a person with money, willing to make an investment. Both of them are looking for an appropriate price. They negotiate. Nobody is weak. Both parties here are strong. They negotiate. They come to arrive at a particular price. Now, this price at which they arrive at is the highest price which this guy is willing to pay and the lowest price which the seller is going to accept. If they agree on this price which has been arrived at by fair negotiation, with full knowledge, under no compulsion. So both of them were free to back out of this deal at any point of time. This is known as the fair market value. So sometimes, like if when we speak about liquidation value, even there, the asset is actually being sold on the market. But there, what do we see? The value is not the fair market value. There, the seller is basically not, let's say, in a strong position. The seller is liquidating the company and his position is weak. The buyer there is the person with the strength, the person with the money, the person who can call the shots. So here the value which is arrived at is going to favor the buyer, not the seller. So it won't be fair actually. It will be a market value, but it won't be a fair market value. So just you can use that to understand what is happening here. Fair value is, the meaning depends on the context. In a merger, the minority shareholders may agree with the amount the acquirer is paying for their shares. So they may want to get it appraised by an analyst or valuer. So let's say that company A is acquiring company B. Now company B, the large chunk of the shares are with the promoters and with the bigger shareholders. But there'll be a section of these minority shareholders whose individual value, the amount of shares that they hold are very small. Now, they are looking for a fair value. They're saying that, look, if you're acquiring this company, we don't want to stay with you. You buy our shares. Now, what is the proper value for these shares? So they can get these shares appraised by an analyst or a valuer. That will be a fair value. In another context, a buyer may be willing to buy, but the seller may not be willing to sell. In such cases, fair value is the amount that will compensate the seller for being involuntarily deprived of his property. So let's say that there is a case where the seller is not actually willing to sell, but there are certain compulsions where, you basically want to, the buyer wants it. The seller is not willing. So here, what is the price at which the seller will agree to sell? And you call that the fair value. So these are different ways of valuation that we've looked at here. Now, let's look at this particular thing here. So it's an all cash deal. Let's say one company. So see, please remember that when we do this, when we do these slides that are coming, essentially what we are looking at here is a situation where one company wants to buy another company. So when the company which wants to buy the other company, that company is known as the acquirer because it acquires the company. And the company which is being bought is normally known as the target company. Because the acquirer has, basically targeted the company for acquisition. So there are two ways in which this can happen. One is that the acquirer company pays cash to the shareholders of the target company. And in that particular case, all that is relevant is what is the valuation of the target company. Target company, the valuation is made. They will generally expect a premium over the market price. And this particular price, this will be a the value of the company in an all cash deal. So on an average, an acquirer pays more than the market value of the equity because there has to be some incentive. And remember out here, what is the alternative? The alternative is I don't give you cash. I buy the company. I issue shares of the new company. So you are compensated, but you're not compensated through cash. You're compensated through shares. We agree on a share swap ratio. So let's say you had 100 shares of the old company. I come and buy your company. And let's say I say that, yes, your shares are pretty as valuable as mine. So we give you 100 shares of our company. Or we say that, no, your shares are not as valuable as those of my company. So basically, 2 of your shares are equal to 1 of my shares. Therefore, for 100, I'll only give you 50 shares of my company. So in that particular case, what I'm doing is, I am buying your company using shares. So it's a good deal for the acquirer company because there's no cash outflow. It's not paying any cash. It's just giving shares to the shareholders of the target company. So in that case, I would call it a share swap deal. And where shares are not involved in the payment process, where the deal is entirely in cash, that is, I'm paying cash upfront to the shareholders of the target company, that we will call an all cash deal. But like I said, it's not as simple as just finding out what is the total value of the shares, the equity shares of the company, and then paying that. It's more than that. Because the target company will have to be incentivized. It has to be given some incentive for selling. So that is the reason why the acquiring company has to pay a premium. Now, why does it actually want to acquire a different company? So some of the reasons are that, let's say that there are 2 companies, both are in the business of, let's say, selling cars. I go and buy your company. So what am I doing? You had a certain market share. When I bought your company, I was able to buy your market share also. So it's guaranteed that the sales of the combined entity will increase. So that's my first thing there. Then the second thing is, I have eliminated a competitor. So since you were making automobiles, I was also making automobiles. By buying you, I have basically taken your company out of the competition. You are no longer a competitor for me. Number 2, since my size has become bigger, my market share is bigger, I am making it more difficult for a new company to get into the picture. Suppose a new competitor wants to come in and set up a business making automobiles. It's going to be more difficult for him to come because I've raised the entry barrier. The entry barrier is a new entrant entering this new industry. He will now have to think that, look, here is a big giant company. It has a fairly big market share. Can I go there and compete? It's a huge investment that I'll have to make to set up this factory. Even if I get all permissions, even if I get the money, I get the right technology, ultimately I'll have to produce cars that sell in the market. Will I be able to actually do that? And the bigger the company, the bigger the challenge is for a new entrant. And that challenge which he faces, that is the barrier. Then, by buying a new company, what you do is you add new products. So let's say that that particular company, producing cars, it had its own range of cars. You had your own range of cars. So between the 2 of you now, you have a larger range. So you're adding new products, which to your own array of products. And other reasons can be you're entering a new market for its existing products. So let's say where you have cross-border acquisitions happening, a company sitting in Japan wants to come and do business in India. So if it acquires a company here in India in the same line of business, it can basically immediately get into the Indian scene, immediately begin to sell its products here by using the distribution chains and local resources of the company that it has bought. So think of, let's say, Suzuki sitting in Japan. Suppose it had come here and bought Maruti. So that it would be something like that. So Maruti is selling cars here. Suzuki is there. Suzuki, if it were to come into India and try to sell cars on its own, it may feel that it's easier to do this if I just buy a company which is a known brand there and sort of sell my products using that brand as my entry point. So basically entering a new market, you can do that. Another risk, acquiring a low risk, high market share, high margin and stable business with potential cash flow. So I identify a company which has a high market share and let's say the growth prospects of the whatever they're dealing in is very good. So in that particular case, there's not much of a risk involved. If I have the money and I go there and I can negotiate a fair price, basically what will happen is that I'll be able to get a good business. And in that way, I can expand, my own company by getting this good business, and I'll be able to, grow at a faster pace by buying a whole company, as against trying to grow year by year and gradually increasing my business. I take an existing business which is there, I buy it, and if this existing business already has a high market share, I can become really big. This process of buying an existing business is sometimes known as inorganic growth. Organic growth is the growth that you generate on your own. Inorganic growth is growth that happens when you buy something else and add their assets and business to your own. So there can be another possibility also. Let's say there's a company which has a large amount of off-balance sheet assets. So let's say it has assets which are not mentioned on the balance sheet, but it's there. You know it. So you can also, sort of buy the company for those assets. That's another benefit which you can get. Now, we come to so these are the reasons. We understand now that there can be all cash deals. We understand there can be, share swap deals. We keep in mind the context that there is an acquirer, there is a target company, and a valuation process is going to happen. This is what basically we are going to do. So first we distinguish between valuation of the business and valuation of the company. So as we go ahead, these two things are going to become clearer to you. So business, when we say business, we are talking about the operational activities of the company. So the value of the operating assets, land, building, machines, equipment related to the production process. This is the business. So it's only about the operational activities of the company. Now, there can be other assets that the company has which are owned by the company, but which are not part of its operations as such. So maybe it could have a lot of land. So, this land, you take, for example, DCM. DCM, Delhi Cloth Mills, once upon a time in Old Delhi, it had its factory there. The factory is still there. It's sitting on, the company itself is not using that factory anymore. It's a non-operational asset because it's not part of its operations. Operations would be that part which is producing the goods which the company sells. Now, this particular factory there is now, it's over, it's closed, but it's sitting on priceless land. So if ever DCM were to be valued, what you will find is that apart from the operating assets of the company, this will be added to it, and this is going to be a huge chunk of the total value because it is sitting on land which is in a densely populated area of the national capital, and as such, it is huge in value. So when we say non-operating assets, don't think that these are inconsequential. These are very small. These can be very significant if if it is land bought in the past. It could be a patent that you're not using right now. But maybe technology has come today which will allow you to unlock the value in that patent. So there are many, many things here which can actually help you. Okay. Second part. So let's just try to look at this in terms of simple equations. So let's say that the value of the company is equal to the value of the business plus the value of the non-operating assets, what we said. So value of the company is equal to the value of the business, the actual, the operative part of the company, and the value of the non-operating asset. So this is one way of thinking of valuation. I value first the actual operational structure of the company, and then I look at the non-operating assets. I add these two together, I get the value of the company. That's one way. Now, value of the company. So let's try to now, go into a little more depth. So I say that value of the company is equal to VE, value of equity. So one of the, the ways of looking at it is, what is the total amount of money that has gone into this business? Where did they get, what are their liabilities? Where did they get the money from to do the business? Because remember, the total liabilities will be equal to the total assets. So what is the main source of liability here? One, of course, will be the equity shares. So the value of equity plus the value of debt. The company may have borrowed, it may have issued bonds. It may have taken loans from banks. So these are borrowing. So these guys also have an interest in the company. And this is a source of fund for the company. Both funds obtained from the equity, the funds obtained from debt, loans and bonds, and the funds obtained from preferential shares, VP. These are the basic long-term funds that the company has. So basically, if I take these, it should be equal to my net assets. So if I look at the balance sheet, on the liability side, I'm going to have the long-term sources. On the asset side, I'm going to have my major assets, the fixed assets, the long-term assets, and the current assets. So basically, if I take all the long-term sources, VE, value of equity, value of debt, and value of preference shares, add them up, I should be able to get my operating assets. And this should also be equal to my non-operating assets. Because remember, the non-operating assets, I'm not using them, but I bought them at some point of time. And where did I buy it from? I bought it with these funds. So I may not actually be using it, but I bought that land. Let's say it's land. I'm not using it for any factory purpose or anything like that. It's lying there. It's in the name of the company. So logically, if you look at it, these long-term sources have basically valued my assets. These assets are equal to the operating assets plus the non-operating assets plus the current assets minus the current liabilities. So the current assets and current liabilities are essentially the working capital component of the company. Company, to run its business on a day-to-day basis, it requires a bit of current assets. Like, for example, it requires inventories. When it processes the inventories, there's stock in process. Later on, it produces finished goods. These finished goods are sold. Some of it is sold on credit, so it creates a receivable. So these are the current assets. So where is this financed from? These are mostly financed from current liabilities. So the current liabilities could be trade credit. They could be the cash credit given by a bank. So the other liabilities could be money which it owes other people. It may owe its own employee their month's salary. It could have bought raw material from suppliers on credit. So those are the current liabilities. So those are not mine. I have to pay those things. So basically, if I take, coming back to this again, if I take the total of the operating assets, add the non-operating assets, add the current assets, I have all the assets of the company now for my valuation process. And I reduce the current liabilities because these are liabilities I have to pay. And they are current liabilities. That means they have to be paid currently. That means within a year. Within a year is just a definition. Actually, they have to be paid long before that. So if I do this, I begin to get an idea about the different components of value for my valuation process. I hope this part is clear. If not, we'll look at this in our next lecture also to get an idea about what exactly is happening here. But to proceed, so I've tried to, put this here more clearly for you. VE is value of equity, VD is value of debt, VP is the value of preference shares. So when you basically look at these equations here, you can sort of keep looking here at the same time and understand this a little better. So remember, these are all liabilities and make up the sources of funds that businesses use for operating. Now, this is the same as net assets, which is fixed assets plus current assets minus current liabilities. This is again equal to the operating assets plus non-operating assets plus CA minus CL. That is operating assets plus non-operating assets plus current assets minus the current liabilities. So whichever approach I take, I'm going to end up with the same value. So the operating assets are the assets which are used to manufacture the products. Like we said, the non-operating assets are owned by the company, but not used for the operational part of the business. So like we said, a simple example of this is land. All the older companies that you can think of in India, you think of the Tatas, you think of the Birlas, these are people who came into the game when land was cheap. And at that point of time, whatever they bought for their company, they would have paid good money for it then. But as land values have increased, as urbanization has increased, basically the land that they bought, which could have been at the edge of the cities that they were operating in, today, though that same land has, it's in many places, it's right in the center of the city. And the value of that is huge. So basically, these non-operating assets today have also become, for the older companies, it's a big substantial thing. So I want you to remember that. And then we come to, is there anything else here? One thing in this slide, which you may want to note, is the intangible assets, brand equity, customer relationships, human resources, goodwill. At the time of valuation, these things, the brand equity, the customer relationships, like people may have very talented personnel there. Sometimes, in fact, you'll be surprised to know that a larger company may buy a startup not for anything that the startup has done. Any particular, I'm talking about tech companies, today's e-commerce business and all that. Maybe, the startup really doesn't have a big market. But this big company buys that company mainly for its human resources. It sees that the quality of human resources in this startup is good. They have managed to keep this startup growing over the last many years. They've written the code, they've done their work, and they know the whole space inside out. So they say that when we acquire this company, we also acquire these guys. So they make it very comfortable for these chaps to continue with the new company. And the purpose of the acquisition in such cases is the human resources. So this small startup may not actually have goodwill. It may not have great customer relationships. It's very small. It may not even have, a great brand equity. It's not that well known. It's too new to the game. but it has good human resources. And the acquirer may actually do that and pay a good amount of money for this also. So in the concept of valuation, these intangible assets also play a role. And these actually become part of the premium that the acquirer pays for the company. That's the point which I was basically making in the earlier slide when we talked about premium. So this is how the premium actually takes shape. And next, so now we come to these different models of valuing the company. One of them is known as Tobin's Q model. So what we'll do is, since we are now getting into, we've covered the basics of the valuation process, and we'll now be getting into actual methods of valuing and understanding how to arrive at actual figures. Given a certain number of, a certain amount of financial data about the company, we can actually arrive at actual values. I'll show you some simple examples and how it can actually be done. This Tobin's Q model, we'll go into it tomorrow, so that we can start off, with a fresh mind and begin to look at these, afresh. That's the whole idea. So for today, I hope it's okay to end here, and we'll meet tomorrow and we'll continue with this. Go through this presentation. Anything which you find is not clear to you, anything which I have not managed to express so well, you tell me about it tomorrow and we will discuss it in much, much more detail with examples. So I think I can end here today. Good night to all of you, and see you tomorrow. Bye.